So let's talk about going public. Most companies exit either through M&A or an IPO. Exercising right before an IPO is not usually the best strategy. It's happened many times where I get a call from a prospective client and they say, oh, I think my company is going to go public in the next 6 months. Should I exercise now? And usually the answer is, well, what is it going to cost you? It tends to be a high watermark in the company's historical valuation before they go public, stands to reason. So in this example, the taxable spread can be massive if you're an early employee, triggering a huge AMT tax bill or ordinary income tax if it's restricted stock or restricted or non-qualified stock option. Or if the person isn't a long-term employee, perhaps they just joined in the last couple of years, well, they still could have a really, really high strike price because that would have been given at the value at the time. So even if they don't have a large taxable spread, they could still be looking at a purchase price of well over $1 million, and it's just not feasible. The other thing to keep in mind is, again, stocks don't only go up. So Jay Ritter, University of Florida, he is the absolute foremost expert in all things IPO statistics, and here are some really good ones. So average IPO returns versus similarly sized firms, according to his research. The first 6 months after the company goes public, the new IPO tends to outperform modestly by about 1.2%. In months 6 to 12, which not surprisingly coincides with the share release, those new IPOs underperform on average about 4.6%. Supply and demand, there's been plenty of studies that show that the flood of shares hitting the market has price pressure. Unfortunately, for employees or stockholders at newly public companies, it doesn't get that much better in year 1 and 2 relative to similarly sized firms. So it is just something to keep in mind as you are considering how to take profits, which we'll get to on the next slide. And what you want your continued exposure to be is not underestimating the volatility of this concentrated stock holding. So when a company goes public, one of the things that you can consider doing as a strategy is using the calendar year to your advantage. So don't blindly think that just because you have incentive stock options and there is a tax benefit of long-term capital gains, if you hold it for this 2-in-1 holding period, that you have to do that. You don't. So one of the things that can make sense, if you know an IPO is coming, you can exercise early in the year, maybe in Q1, and reevaluate towards the end of the year to see what your AMT tax bill might be if you don't sell the shares before the end of the year. By exercising earlier in the year, the idea would be that any lockup period would have expired by then and you would have liquidity. Of course, it's not perfect, so you would want to put that into your calculation. But if you would trigger an AMT tax bill that would be just too large for your comfort, or you would simply just need liquidity to pay for it, well, then you can actually just do a disqualifying disposition and recognize regular tax on that spread, because if you don't own the shares at the end of the year, then those shares aren't subject to the AMT. So you can also see what your tax situation is for all of your other income at that point. Once it's later in the year, more of that is known, and make a determination as to what makes sense for you. So the lockup period, this is usually 180 days, and it's important to note that it will extend very often to not only current, but former employees as well. So during this lockup period, you are essentially unable to sell, pledge, hedge your position. You might not be able to do a cashless exercise during this period as well. Most often, you're not able to even move the shares out of the custodian that they're currently being held at until this lockup period is over and those shares are actually released. As a best practice, if you leave an employer and you take shares with you, you've exercised them, keep your contact information updated with this current employer. They are going to mail you, email you all the information that you'll need about the lockup, the expiration, whether it applies to you, where your shares might be moved to, how to get them out of there. It's just a wealth of information. And again, as a best practice, before you leave the company, download all of your stock grants, all of that information from whatever system they're using, because you could lose access to it. Keep in mind, as a current employee, once the company goes public, expect blackout periods. It's standard for that to happen around earnings releases. You could also be considered an insider. And even if you're not to the level of an SEC insider, you still might have a role at the company where you have blackout periods. Those can extend all year. I mean, having material non-public information really can apply to a lot of different people. So just keep those types of things, again, that you can't control, in mind when you are relying on selling shares for liquidity, perhaps to pay tax, because you might not have it. Again, insiders would have a host of other considerations, filing requirements, potentially wanting to use a 10b5-1 plan. That is outside of the scope of this, but certainly something that we do regularly work with clients to support them on. So now let's talk about taking profits. So turning paper profits into real diversified gains. That's what we mean by that. It's so important to have a plan in place to diversify. And again, stocks don't only go up. There's a stunning statistic here from JP Morgan. Between 1980 and 2020, nearly 45% of all companies that were ever in the US stock market, as judged here by the Russell 3000, experienced a 70% decline in price from the peak and never recovered. We have seen this with clients over the last, let's call it 2 years. It happens. We have way more people in our client base than we would like that it has happened to. So this is very real. When we cite statistics as financial advisors about how the market moves and the benefits of investing over time, that applies to the market, but it doesn't stay the same for one single company, right? They don't move the same. One company is going to be much more volatile, upside and downside, than the market. So it's just so important to recognize that and to not pre-spend the proceeds, right? Because when you are holding onto that concentrated position, maybe it's worth $10 million in your account, but you haven't sold it yet. So that $10 million in this example, right, could become $3 million. And if you buy that expensive house or the boat or what have you, if you pre-make that lifestyle decision, then the money could potentially not be there for you, and it could put you in a really, really tough spot. So as we are talking to clients about what price targets should be and when they should sell and exactly how they should get their arms around that, one of the things that I think is helpful is to consider base, best, and worst case scenarios. So one of the things we often hear is, I don't want to sell now, I want the stock to recover, or I think the stock's going to go up, I don't want to sell now. Okay, so let's walk through this. Let's assume that you could sell that stock today for $1 million, and that's just the base case because that's what you could currently do. In the best case scenario, let's assume that it could go up by 50%, which is huge. That's an incredible gain. And you could sell it for $1.5 million. Certainly better than $1 million, yes. But now let's assume that the worst case scenario is the stock actually goes the other way and it gets cut in half. And all you get from it is $500,000. There's no reason to assume that one of these situations has a higher probability than the other. So when faced with $500,000 or $1.5 million, or just the known quantity of getting $1 million today, that base case really doesn't look so bad anymore. And it's something that you can control. So just really try and be honest with yourself about what the likely outcomes are and make sure that you're comfortable taking that risk should you choose not to sell when you're able at the price that is prevailing in the market. It's very common for employees of either whether they're a current company or whether it's a former company, when they have a large holding there, they tend to be very bullish on that stock in general. So one of the things I like to ask clients is, if you were given a cash bonus today, what would you do with it? Would you buy more stock from this company? I've never had anyone respond yes. So that should just be telling to you that when you see this stock is worth $1 million in your account, is that $1 million more valuable to you, or holding on to the stock and taking that risk in the future? And it doesn't need to be all or nothing. It doesn't mean you need to sell all of it in order to achieve that diversification. But if you have more than 10% of your net worth tied up in this stock, as most people with concentrated positions do, they're taking on a lot more risk than they perhaps will want to when looking back. So there's some different strategies that we'll use when working with clients to diversify a concentrated position. A lot of these do require a really robust investment process. financial advisory team, and even a trading team to manage them. We will work very frequently with the institutional trading desk to actually execute a lot of these options when they're available to clients. So it's not something that we would suggest doing on your own. Also do want to mention that these options not only wouldn't be available during the lockup, but might not be available if you're a current employee, as those individuals are usually limited in anything they can do from the option standpoint. But just to walk through a couple of these strategies that you might want to consider. So a limit order. A limit order is setting a price target for a future sale in this example. So let's say you have a stock and it's currently trading at 15. You don't want to sell it till it's worth 20. What you could do is put in a limit order, and that order would trigger before it expired, which you can usually go out, 6-8 months or something like that, and say, hey, when this stock gets to at least 20, try and sell X number of shares. Another strategy, which we really like a lot, is called a cashless collar. Now, what this strategy does is two things. It allows you to sell a call option. So following on the existing example, the stock is trading at 15. Perhaps you sell a call option for 20. So that means that you are selling to some other investor in the market the right to buy that stock away from you at $20 a share. In exchange for that, you can purchase a put. So that's the other way. So if the stock's at 15, perhaps you are purchasing the right to sell that stock to someone at $10 a share. That's expensive. So usually it doesn't make sense just to purchase the put, because the cash outlay can be very considerable. And either of these strategies are only in place for a certain period of time, usually just a few months. So it's short-term protection, but by doing the cashless and selling that call option, in theory, at a price you'd be happy taking anyway, it can really make it either so that you don't spend any money doing this, or at least drastically reduces the outlay while you wait for a more favorable time in the market. Although it doesn't provide you any downside protection, one of the options that you could also consider is selling a call option. So the first leg of the last example, and that will just provide you income while you wait for that call option. If it gets called away, again, it's, in theory, it's at a price that you're happy with, but if it expires out of the money, perhaps at $16 a share, then nothing happens and you still just get to keep the income. So that can be another strategy. A market order is just, the base case over on the left side here of just selling at the prevailing price. There can be different strategies we'll consider, whether we just do it all at once, whether we try and do it over time, whether it's a dollar amount, we're looking to stay with under a tax threshold for the year. There's a lot of different things there. But again, we've run into a lot of different issues in working with clients. So it's important to recognize that your situation will be different. It just will be. The option strategies we discussed, they're not available for every client. Perhaps the company just doesn't have an options market, right? So typically companies need to be of a certain size and have enough volume and interest to even have an options market for it. So if it's a smaller IPO, it's very unlikely that that would be something you could consider. You also need to consider liquidity. So that's the idea of not your liquidity, but how liquid the stock is. So again, if it's that smaller company, they may not have a lot of shares that are exchanged day-to-day basis. So we've had a client that had a few 100,000 shares, and ideally he would have loved to have just hit sell and exited the position in one day. But in this example, there are only about 50,000 shares that were changing hands every day. So he couldn't exit the position without drastically moving the market and driving his price down. So these are some of the things that we will consider, again, in working with the trading desk and really making sure we're keeping a keen eye on the client situation, considering blackout periods, insider rules, all that sort of thing. So another option to try and mitigate risk is managing the rest of your portfolio around a concentrated stock while you are trying to diversify. So for example, if you're working at a big tech firm and that's where all of your stock is, perhaps we would be managing your portfolio without investing in the NASDAQ QQQ, for example. So that's just another thing you can do to try and reduce your risk. And finally, just can't stress enough the importance of a one-time nature of a sudden wealth event. So you can only spend $1 once, really being thoughtful about how to spend invest, and enjoy the proceeds from this liquidity event. The importance of that just cannot be stressed enough.